So exit number one was an interesting one. Business was growing very nicely. I mean, I think we triple. We were on our doubling path, at that point. So we're going from like 12 to 24 million in revenue. Bookings are looking great. Net revenue retention is insanely high. So business is good. We're clearly monetizing the data, building a reputation. We're a hot company in the space. But we're still burning cash because we spend, $8-10 million a year on our panel asset. And so, when you're only generating 12 million in revenue, even though the bookings are looking great, you're still burning cash. We've proven the sales model, all of those things were there, but we needed cash if we were going to keep growing at that kind of rate of continuing to double or more. And so I started looking at fundraising for a Series C. And as I was doing that, honestly, there wasn't a ton of interest in us. People couldn't get past the gross margins at the time, or just many other aspects of the business. And those that did, the kind of valuations we were looking at weren't great. And so one of the things I looked at is, well, maybe we raise a little bit less, and we have a conversation with some of the strategics in the space. And so, we started talking to some companies that were broadly in this market research panel space about, a smaller fundraise to just allow us to keep growing and get a little closer to them anyway. And, very simply, one thing led to another, and the conversation started getting more and more strategic. And to keep our foot on the gas and keep growing, no matter what happened from those strategic conversations, I took some venture debt. Turned out to be one of the best moves I ever made as a CEO. Our investors didn't like it. Our executive team didn't like it. And it turned out fantastic at the end of the day because it preserved, the equity and ownership for all of the existing investors when an exit did come about 6 months later. Because what ended up happening is, all of a sudden we get one offer to be acquired. It's semi-interesting, but it allows us to bring in a banker and drive conversations with others. And the next thing you know, the whole thing snowballs and becomes quite a race. And what was so funny about it is we had actually had a signed letter of intent with a strategic acquirer, but they didn't continue on their end to move things forward the way they needed to. And so it expired. And the day after it expired, I met with Vista Equity Partners. And they moved so fast. They loved the business. They were already working on an acquisition in an adjacent space called Market Track that was much larger, but not growing, but very profitable. And they saw an opportunity to buy both of us together, put them together, and take all of the sales team, all of the existing client base, all of the existing data assets that it had, and all the profitability, and further deploy them to continuing to grow what was the InfoScout business. Mm-hmm. And so that's what we ended up doing is, cool. We put the two companies together. We formed Numerator. We changed the name of the company, and it's been a fantastic run. The company has just continued to grow and grow and grow, and is nicely profitable. And I think just a super healthy business as it scaled the way that we always knew it would. But honestly, we couldn't always convince everyone that that's what it was going to look like in the future.